HDFC Life has just released its Q1 Financial Year 26 results. Profits surged, premiums climbed, and margin stayed strong. I will break them down, compare them with analysts' expectations, share management insights, and help you decide whether to buy, hold, or sell. Let's dive in. But before that, please subscribe to my channel Finance Eco India. So friends, HDFC Life delivered a powerful quarter. Standalone profits jumped 14% year on year, rising from Rs 478 crore to Rs 546 crore, comfortably above street forecasts. Net premium income came in at Rs 14,466 crore, up 16%, exceeding analyst growth project of 10 to 12%. Annual premium equivalent, a key new business matrix, grew approximately 12.5% year on year, boosting the 2-year compounded annual growth rate to 21%. So value of new business or VVN rose 12.7% to Rs 809 crore, with margins holding firm at 25.1%. Assets under management climbed 15% year on year to Rs 3.56 lakh crore, and embedded value reached Rs 58,355 crore, with a rolling return on embedded value of 16.3%. So now let's discuss what management has to give commentary on this. CEO Vaibhav Pathak said, Q1 began on a strong note with healthy top line, higher VNB, and stable margins. We outperformed industry growth, gaining 70 basis points overall and 40 basis points in the private sector, reaching 12.1% and 17.5% respectively. She added that over 70% of new customers were first-time buyers, particularly from Tier 2 and Tier 3 markets, highlighting strength in acquisition and distribution. The company expects a gradual shift toward traditional and protection products rather than any sharp swing, emphasizing stable product mix and disciplined execution. So now let's discuss about the stock reactions and technicals. Ahead of results, HDFC Life sharp price already reflects bullish step up, trading above Rs 740 to 755 support after a 1% pre-open gain. On earnings day, volume increased as market responded positively to the stellar numbers. Analyst from SEBI registered Rohit Mehta suggests that as long as the share price hold above Rs 755, the bullish momentum remains intact, with resistance near Rs 778 to 790. A breakdown below Rs 740 could test Rs 715 to 725. The stock is currently trading around 10.1 times book value with a consolidated pay ratio of 27.4%, key indicator for valuation reference. So friends, now let's discuss what analysts and brokerages had to say about HDFC Life result. So brokerages had forecast 15 to 16% AEP growth and around 26% VNP margin. The actual result met or exceeded these estimates. Money Control noted the strong premium growth, rising margin, and reduced regulatory overhead as positive catalyst. Persistency ratio remained robust, 13-month at 86% and 61-month at 64%, reinforcing customer retention. A Reuters report highlighted that group insurance demand remains strong, especially in renewable premiums, while ULIP's low-margin products started to slow, now making up 38% of the product mix. Importantly, VNB margin stability reflects a strategic shift toward higher margin protection and non-par products, showing margin resilience amid shift in product portfolio. So now let's discuss what investors should do. For long-term investors, this is a strong quarter. Top line growth, margin resilience, and market share gain make it a buy or hold at current levels. Watch for any major dips near Rs 755 as accumulation zone. For short-term trader, normal trading strategy is to enter at Rs 755 to 770 with a stop loss around Rs 740. Target resistance lies at Rs 785 to 790. What risks to monitor for this? Any decline in VNB margin from shifting product mix, like higher exposure to group savings or ULIPs. Macro factors such as rate cut, bond yield shifts, or market volatility that could impact investment income. So for long-term upside, continued digital distribution growth and acquisition strength in Tier 2 and 3 markets. Improved persistency and deeper product mix shift, especially in protection and non-par. Now friends, let's summarize. HDFC Life posted an impressive Q1 beat with robust profits, premium growth and a stable margin. The stock is technically strong with upside potential, especially if support level holds. So friends, please like this breakdown, subscribe for more earning analysis and comment below, are you buying this dip on dip or holding through the rally? Thank you. Jai Hind. Hello friends, welcome back to my channel Finance Eco India. Today we are unpacking ICICI Bank's Q1 Financial Year 26 results, net profit, margin update, analyst reaction, investor signal, management guidance and the growth roadmap. But before that, please subscribe to my channel. Let's get started. ICICI Bank posted a standalone profit of 12,768 crore, up 15.5% year-on-year, easily beating analyst estimate of around Rs 12,024 crore. Net interest income climbed 10.6% to Rs 21,634 crore, driven by 12% loan growth led by corporate and business banking. However, margin narrowed slightly to 4.34% due to RBI rate cut. Analyst has projected a PAT range of Rs 11,649 to 12,382 crore and NII growth between 7 to 9%. ICICI delivered Rs 12,768 crore in profit, comfortably beating consensus and surpassed NII estimates, although margin declined slightly. Overall, a solid beat on both fronts. Total loan grew by 12%, powered largely by commercial and business banking. Despite rose about 13%, asset quality improved. GNPA fell to 1.67% from 2.15% a year earlier. However, provisions spiked 36% to Rs 1,815 crore, reflecting prudence amid potential credit risk. ICICI management credited the profit beat to robust loan growth and higher NII. They acknowledge margin pressure from rate cut but expect improvement through better pricing and mix. They reiterated focus on credit quality, citing tighter provisioning to manage risk. So for investors, the beat confirm operational strength. Keep close watch on margin stability as NIM tighten. Rising provision underscore credit cautious. From a technical standpoint, a breakout above Rs 1,430 to 1,440 could trigger further gains. Stock is already up 0.5% today. So looking forward, ICICI aims to sustain 14 to 15% loan growth while managing NIM amid rate cut, scale up investment in digital banking and SME lending continues. Key risks include macro slowdown and interest rate volatility. Now let's summarize. ICICI Bank delivered a strong beat on Q1 profitability and core income. Loan book expansion and improved asset quality are encouraging, though margins and provisioning trends warrant attention. For investors, maintain your position but stay alert to names and potential provisioning surprise. Thanks for watching. Don't forget to like, subscribe and let us know if ICICI is on your radar. Thank you and Jai Hind. Hello friends, welcome back to my channel Finance Eco India. Today we will deep dive into Angel One's Q1 Financial Year 26 financial results. Today we will be analyzing their performance with a particular focus on how these numbers stacked up against market expectations. But before that, please subscribe my channel and hit the bell icon. So friends, let's start with the headline story. How Angel One performed against analyst estimates. On the left, we see net profit after tax. Analysts estimated rupees 1,326 million, but the actual result came in lower at rupees 1,144.68 million, indicating a moderate miss. This was pressured by lower revenue and significant one-off marketing expense. On the right, the picture for total income is starker. Analysts projected a robust rupees 48,995 million, but Elgin well reported rupees 11,430.93 million. This represents a closer shortfall against expectation, signaling fundamental headwinds for the company's top line. So friends, let's unpack the profit and loss story. The donuts chart on the left illustrates Angel One's revenue from operation breakdown. Fees and commission continues to be the primary driver, making up the largest portion of their operational revenue. However, a significant factor impacting profitability this quarter was highlighted by our key expense spotlight, the IPL sponsorship. A substantial 1,117 million was spent on this discretionary marketing campaign. To put that in perspective, this single expense was nearly equivalent to the entire net profit after tax for the quarter, highlighting its material impact on the bottom line. Now moving to the operational engine, we see a divergent client story. The bar chart on the left shows a sharp drop in gross client acquisition year on year, while Q1 Financial Year 25 saw 2.5 million new clients. Q1 Financial Year 26 recorded only 1.5 million, a significant slowdown in new user sign-ups. This is a key concern for future growth momentum. However, the client chart on the right illustrates that despite this slowdown in new acquisitions, Angel One's total client base continues to grow robustly, reaching 32.5 million in Q1 Financial Year 26. This indicates a strong client retention and engagement for their existing user base. Now let's talk about the core business. Trading volume shows sign of pressure. On the left, for the number of orders processed, we see a modest 4.8% quarter-on-quarter growth. However, the year-on-year figure reveals a significant 25.8% decline. Similarly, the chart on the right for average daily turnover or ADTO shows an 11.7% quarter-on-quarter increase, but a 18% year-on-year decline. These year-on-year contraction, particularly in high-margin segments like future and option, are a direct consequence of stricter regulatory changes. So amidst the challenges in core broking, Angel One's strategic diversification is proving to be a bright spot. On the left, their client funding book has reached an impressive 48 billion, making an all-time high. This indicates deepening client engagement and successful growth in their leading activities. On the right, wealth management assets under management or AUM shows explosive growth, increasing by 33.6% quarter-on-quarter to reach rupees 50.7 billion. This figure demonstrates that Angel One's effort to expand beyond traditional broking are bearing fruit and providing a crucial hedge against market volatility. Now let's discuss the main reason behind the poor performance of Angel One. The quarter's performance cannot be fully understood without acknowledging significant external factors. This flowchart illustrates the chain of events. The cause was stricter SEBI F&O regulations. The immediate effect was a sharp decline in F&O volumes, down approximately 38%. The impact of this was clear: significant pressure on Angel One's high margin revenue streams, and the reaction from the market was swift and decisive, with the stock dropping over 5% and analysts issuing downgrades. In conclusion, Angel One's Q1 financial year 26 results presented a mixed and challenging picture. We saw a significant miss on total income and a moderate miss on net profit after tax, primarily driven by the impact of stricter F&O regulations. The core broking business faced considerable headwinds with year-on-year decline in trading volume. However, the company demonstrated resilience through strong growth in its non-broking segments such as client funding and wealth management (AUM), highlighting a successful diversification strategy. The market's negative reaction and analyst downgrade underscore the ongoing impact of regulatory changes. For investors, key watch point moving forward will be how Angel One navigates these regulatory challenges, continue to scale its non-broking revenue streams, and whether management's optimistic outlook for a business pickup by year-end materialize. Angel One's strategic pivot toward a broader suite of financial service will be crucial for long-term growth amidst this evolving market landscape. If you like the analysis, please like, comment your thoughts and subscribe my channel. Thank you and Jai Hind. Hello friends, welcome to my channel Finance Eco India. Today we are diving into Q1 financial year 26 earnings for HDB Financial Services and ICICI Lombard. One shows slowing profit, the other strong growth. But what's the full picture? In the next 5 minutes, we are analyzing key numbers, market reaction, management commentary, and investor strategies. So, for more details, please subscribe to my channel Finance Eco India. So let's get started. So let's first discuss HDB Financial Services, the NBFC arm of HDFC Bank. Their Q1 PAT fell 2% to Rs 568 crore from Rs 582 crore a year ago, due to a sharp 63% jump in loan provisions, as gross stage 3 loans increased to 2.56%. However, revenue grew 15% to Rs 4,465 crore, driven by 18% growth in net interest income, thanks to a robust 14% loan book expansion. The drop in profit despite healthy NII growth points to rising credit cost, assets quality and provisioning are key watch point. So HDB Financial Services share closed around 842, just below the IPO listing levels of Rs 835 to 849. HDB debuted strongly at a 13% premium on listing day, but profit weakness and rising NPA may keep the stock range bound near Rs 830 to Rs 850. Breakout above would need sustained loan growth with controlled provisions. Now let's discuss what investors should do for HDB. For long-term investors, if you believe in the growth of its unsecured loan book and performance under HDFC Bank percentage, accumulate near 830 to 835 on dips. This makes sense. Traders should watch 820 support and target Rs 865 to 880, stop loss around Rs 815. So key risk associated with this HDB is asset quality stress, especially rising stage 3 assets, and provision could wait further profits. Friends, let's now discuss ICICI Lombard, India's top general insurer. Q1 profit showed 29% to Rs 747 crore, driven by a 14% rise in net premium to Rs 5,136 crore, fueled by 44% growth in retail health and 13.5% in motor insurance. Profit before tax was Rs 994 crore, up from Rs 774 crore last year. However, the combined ratio was to 102.9%, indicating underwriting pressure. Post results, ICICI Lombard share hovered near 2014, down slightly, reflecting the rise in claim despite profit growth. Analysts flagged strong technical setup. Rohit Mehta noted a bullish breakout pattern with support near Rs 1,975 and resistance around Rs 2,100. The next big leg depend on combined ratio improvement and premium momentum. So now let's discuss what investors should do. Long-term investor may continue holding solid premium growth, high solvency ratio, and backing from ICICI Bank supports the outlook. Position near support rupees 1975 with upside target of rupees 2200 and rupees 2250 if underwriting improves. Trader could claim for rupees 2100 to 2150 on near term bounce with stop loss at rupees 1950. Watch out, any uptick in claims from crop or reinsurance segment may further pressure the combined ratio. So friends, let's summarize. HDV shows loan growth but face assets quality concern, ideal for selective accumulation. ICICI Lombard impressed with growth, though insurance claim remains a risk. If you like more detailed analysis on any of these stocks, hit like button and subscribe and ring the bell for daily stock breakdowns. And let us know in the comments, are you buying, holding or watching these names? So please subscribe my channel Finance Eco India for more such updates. Thank you and Jai Hind. Hello friends, welcome to my channel Finance Eco India. Big news from ICICI Prudential Life. Q1 profit jumped a staggering 34%. Premium rose, cost fell, but ULIPs lagged. Stay tuned for a full breakdown, stock reaction, management insight, and what investors should consider. But before that, please subscribe to my channel, Finance Eco India. So friends, let's start with the numbers. PAT surged to rupees 302 crore, up 34% year on year, a clear beat. Net premium income climbed 8% to rupees 8,503 crore, driven by a 20% jump in one-time single premiums. Annual premium equivalent slipped 5% to rupees 1,864 crore, reflecting slower sales in saving-linked products. Value of new business declined slightly to rupees 457 crore, but the VNB margin improved to 24.5%. AMU grew by around 5% to rupees 3.24 lakh crores, while operating cost fell, pushing the cost to premium ratio down to 21.2% from 24%. So let's discuss what management is saying. MD and CEO Anup Bagchi said our Q1 financial year 26 performance demonstrate the strength and resilience of our business model. Retail protection APE grew 24.1% year on year, and saving business saw cost ratios improved by 270 basis points. Image protection grew over 36% year on year in total new business sum assured, showcasing depth of retail customer engagement. So let's discuss the stock reaction and technical setup. The stock responded positively, rising around 1% intraday, backed by SEBI registered analyst, noting a bullish breakout on technical charts. Analyst Rajnish Sharma highlighted support between rupees 674 rupees 680 and resistance around rupees 720 to 725. A sustained breakout could drive the stock to rupees 760 to 800. So friends, now let's discuss what brokerages are saying. Brokerages pointed out that profit growth was led by improved investment income and cost discipline, despite a drop in APE. ULIP sell fell due to market volatility from US policy uncertainty. However, ICICI Prudential smartly shifted focus to higher margin protection products. Retail protection APE rose 24.1% year on year, while overall protection APE increased 15.2%, signaling a stronger traction in this segment. With an improved cost premium ratio and a solvency ratio of around 212%, the company continued to demonstrate balance sheet strength. So friends, let's discuss now what investors should do. For long-term investor, strong profit growth, rising AUM and protection focus makes this a solid buy or hold. Accumulate near support around rupees 670 to 680 for potential upside to rupees 760 to 800. For short-term traders, look for buy signal above rupees 720 with stop loss near rupees 680. Target are in the range of 760 to 800 June if momentum continues. So what all risk we need to look for? Weakness in saving linked AAP and any reversal in VNP margin, market volatility affecting ULIP premiums, micro headwinds like global market, uncertainty or interest rate shocks. So friends, to wrap it up, ICICI Prudential gave investor reason to cheer with strong earnings, improved margins and healthy protection growth. The stock's technical poised for a breakout, but watch the rupees 680 support carefully. If this analysis helped you, please like, subscribe and hit that bell for more earning reviews and market insight. And for now, what's your move? Buy, hold or wait? Let us know in the comment. So please do subscribe my channel Finance Eco India. Thank you and Jai Hind. Hello friends, welcome to my channel Finance Eco India. Today DMart's Q1 results are out and it's a mixed bag. Revenue surged 16% year on year to 15,932 crores, but margins slipped and profit barely inched up. Will the retail giant sustain its growth or face serious headwinds? We are breaking it all down, from store expansion to online impact and margin pressure. So hit subscribe, turn on notification and stay till the end. I will share what analysts from JM Financial, HSBC and JP Morgan are actually saying. So firstly take the snapshot of the result and then we will discuss in detail in next slides. Revenue surged 16% driven by store addition, but profit grew only 2% and EBITDA margin dropped to 7.9% from 8.7% a year ago. DMart now operates around 424 stores, so while top line keeps accelerating, profitability shows sign of pressure. Want to know why margins are under pressure and what analysts expect next? Stay tuned because there are a lot more ahead. So talking about the revenue growth, DMart reported 15,932 crore in Q1 revenue, making a 16.2% year-on-year increase, a strong indicator of continued momentum. This growth is largely attributed to adding around 6 to 9 new stores during the quarter, raising the store count to 424 as of June 30, 2025. However, while store addition are fueling top-line gain, same-store sales growth is slowing, suggesting that core store performance is moderating even as expansion continues. So DMart's impressive revenue growth is clearly driven by scale. More store, more sales. But the slowdown in existing store performance means the company must focus now on operational efficiency and optimizing new locations to maintain healthy growth. So now let's discuss about the profit and profit margins. So DMart Q1 financial year 26 net profit rose modestly to rupees 830 crore, making a mere 2% increase year on year from rupees 812 crore last year. EBITDA and margin pressure. Meanwhile, EBITDA climbed 6.4% year on year, reflecting cost absorption in absolute terms, but the EBITDA margin shrank sharply to 7.94%, down from 8.68% a year earlier, a drop of 74 basis points. So what's driving the margin hit? Rising operational cost due to continued store rollout and upstick in staff and overhead expense. Heightened competition, especially in metro region from quick commerce platform offering lower prices and delivery convenience. So while the bottom line shows growth, the shrinking margin reveals underlying pressure. DMart's aggressive expansion strategy and competitive pricing model are taking a toll on efficiency. This suggests the company's low-cost leadership is being tested by rising cost and market revenue, even as it continues to grow. So let's discuss why DMart margins are under pressure and why it matters. Quick commerce competition in metro area is hurting pricing power and customer draw, as Goldman, Morgan Stanley, and JP Morgan have flagged this trend. Operation costs are rising due to increased staff and higher overhead from new store rollouts, in line with brokerage preview that expect a 40 to 54% BPS hit to EBITDA margin. Weak discretionary spending, particularly in apparel and general merchandise, has also compressed margins, with the CEO confirming the drop in gross margin due to softer non-FMG sales. So this margin compression isn't just about numbers, it highlights that DMart's low-cost retail edge is being tested by newer, faster competitors, rising cost, and evolving retail mix. This is a critical area to watch for Q2 and beyond. So now let's discuss the analyst projection and is the DMart result is a hit or a miss. So ahead of results, analysts projected 18% revenue growth to 16.5 thousand crore, EBITDA margin between 8.2 to 8.7, and PAT rising 6 to 10% to 817 crore to 892 crore. So actual results are revealed. Revenue increased 16% year on year to 15.9 thousand crore, slightly below the top end of the estimates. EBITDA margin compressed to 7.9%, underperforming the 8.2 to 8.7 forecast. PAT rose just 2% to 830 crore, significantly lower than the 6 to 10% expected. So the top line growth was strong at marginally short of expectation, but the sharper than expectation margin contraction and muted profit growth delivered a mixed message to the market. DMart's expansion worked in driving sales, but cost pressure and competition pulled profitability down. So now let's discuss about the DMart's growth drivers. In Q1 financial year 26, DMart added 6 to 9 new stores, bringing its total count to approximately 424 outlets. That's part of a steady growth strategy, but here's the twist. Same-store sales growth, a key measure of performance in existing location, has declined significantly. It fell from 8.4% in Q1 financial year 25 to just 3 to 4% this quarter. So why this matters? While new stores are boosting overall revenue, the slowdown in established outlets shows weakening underlying demand. DMart is still growing, but the engine is losing steam. Keep a close eye on SSSG next quarter. It will determine if this slowdown is temporary or something deeper in consumer spending. Let's now discuss the DMart's major risks and concerns. DMart's profitability is under pressure from three key market challenges. First one is quick commerce competition. Rapid delivery services are snapping up customer metro areas, and brokers like HSBC, Macquarie, and NDTV Profit warn this trend may intensify further. Inflation is eroding consumer spend. So due to high inflation, consumers are only tied to the household budgets and they reduce spending on the non-essential items. So this led to sluggish discretionary demand. Categories like apparel and general merchandise have slowed sharply, confirmed by Motilal Oswal and Mint analysis. So these stress of fast, cheaper and delivery alternatives. Cost-driven consumer, belt tightening and discretionary slumps are testing DMart's low-cost leadership and growth stage. Navigating these headwinds will be critical in upcoming quarter as they reshape India's retail landscape. So let's discuss the stock market reaction on this result, as although the result has came after the closing of the market. DMart stock opened slightly lower today, around 4,160, trading flat to moderately down on the day, reflect hesitant investor sentiment following the results. Analysts have mixed reactions. HSBC, Macquarie and IFL are cautious, pointing to margin compression and intensifying competition in urban market. JM Financial, on the other hand, is more optimistic, noting that revenue growth remains solid and the stock may offer value at current levels. Overall, the market reaction is muted. Strong top-line performance was offset by margin pressure, leaving analysts split. Margin outlook and competitive dynamics will likely shape the next move. Let's now talk about the management commentary. This quarter marks the first earnings session under the backdrop of a major leadership shift from DMart. Anshul Aswana, a seasoned Unilever executive and IIT-IM alumni, joined as CEO designate on March 15, 2025 and is set to officially succeed Neville Norana as MD and CEO on February 1, 2026. Norana, who built DMart from a 5-store operation to over 380 outlets, announced he would step down after his term ends in January 2026, staying on to ensure a smooth handover. Why it matters? Investors are closely watching this transition. Nora's era shaped DMart low-cost, high-efficiency model. Aswa inherits this legacy and must maintain growing challenges in the retail sector. The market reaction to this vision and early moves will be pivotal for DMart's future momentum. So let's discuss about the final verdict. Should we buy, hold or sell this stock? So DMart continues to deliver strong revenue growth, but this quarter's margin is squeezed and slowing same-store sales raise cautious flags, especially as profit growth lagged. So what are the watch lists for Q2? What should we watch for this stock to buy for Q2? Margin recovery. Can DMart re-expand margin from 7.9% now? Same-store sales growth stabilization. Will core store performance improve? CEO transition clarity. Will the management handover remain smooth? So what should be our strategy? For long-term investors, consider accumulating selectively given DMart's strong footprint and deep value. For short-term trader, wait for clear margin signals and stabilize same-store sales before taking position. So revenue remains a growth engine, but profit efficiency and store health needs more resilience. Keep those eye-level benchmark in Q2 before making your next trade or investment move. So we have discussed a lot about the DMart. Now let's sum up and wrap up this session. DMart shows expansion strength, but margins are a concern. Will upcoming quarter ease competitive pressure? Let me know your views on this and comment below. Like, subscribe and hit that bell icon. And check out our next video for more other companies updates and results. Thank you.
TCS के इन्वेस्टर्स के लिए बड़ा अपडेट। क्या 120 का बम्पर डिविडेंड फिर से आ रहा है? 10 जुलाई को बोर्ड मीटिंग में हो सकता है पैसा बरसे और Q1 के रिजल्ट्स भी होंगे रिकॉर्ड ब्रेकिंग। क्या आप शेयर होल्डर हैं? क्या आपके अकाउंट में पैसा आने वाला है? वीडियो में पूरी ब्रेकिंग डिटेल मिलने वाली है। ब्रेकिंग न्यूज समरी ऑफिशियल अपडेट। TCS ने सेबी को इन्फॉर्म किया है कि 10 जुलाई 2025 को उनकी बोर्ड मीटिंग होने वाली है। इस मीटिंग में 3 बिग डिसीजंस लिए जाएंगे। Q1 FY26 के स्टैंड अलोन रिजल्ट्स अप्रूव होंगे। कंसोलिडेटेड रिजल्ट्स भी बोर्ड के सामने रखे जाएंगे। इंटरिम डिविडेंड का डिसीजन भी लिया जाएगा। व्हाई दिस इज बिग फॉर इन्वेस्टर्स? TCS हिस्टोरिकली हर Q1 में इंटरिम डिविडेंड डिक्लेयर करता है और पिछले 3 साल से एवरेज 8.45 तक का डिविडेंड दिया गया है। लेकिन जुलाई 2033 और 2024 में 9 का डिविडेंड मिला था, तो इस बार भी कुछ बड़ा अनाउंस हो सकता है। रिकॉर्ड डेट इज 16 जुलाई 2025, यानी अगर आपके नाम पे टीसीएस के शेयर 16 जुलाई तक हैं, तो डिविडेंड आपका। Q1 रिजल्ट एक्सपेक्टेशंस। टीसीएस का Q1 FY26 काफी स्ट्रॉन्ग हो सकता है। रुपए डिप्रिसिएशन से मार्जिन बूस्ट, बीएफएसआई और यूएस मार्केट रिकवरी की अर्ली साइंस, एआई और डिजिटल ट्रांसफॉर्मेशन डील्स का अपटिक। मार्केट एनालिस्ट्स एक्सपेक्ट 10 to 12% यूरो रेवेन्यू ग्रोथ और मार्जिन इंप्रूवमेंट। तो डिविडेंड के साथ साथ शेयर प्राइस भी ऊपर जा सकता है। शुड यू बाय टीसीएस बिफोर रिकॉर्ड डेट? डिविडेंड के लिए शेयर्स लेना टेम्पटिंग लगता है, लेकिन एक बात याद रखो, एक्स डेट के बाद प्राइस एडजस्ट होता है। तो अगर आप लॉन्ग टर्म इन्वेस्टर हो, तभी ये डिविडेंड बोनस का काम करेगा। डिस्क्लेमर फ्लैश, इन्वेस्टमेंट एट योर ओन रिस्क, ऑलवेज रिसर्च बिफोर बाइंग। टीसीएस का डिविडेंड ऑलमोस्ट कंफर्म लग रहा है और जुलाई 10 का बोर्ड मीटिंग एक मेजर ट्रिगर हो सकता है स्टॉक के लिए। Q1 के रिजल्ट्स और डिविडेंड दोनों की डिटेल्स फाइनेंस सीखो इंडिया पे मिलेगी सबसे पहले। लाइक करो अगर आप शेयर होल्डर हो या बनना चाहते हो। कमेंट करो TCS डिविडेंड 2045 आई एम रेडी। सब्सक्राइब करो फाइनेंस सीखो इंडिया को फॉर द लेटेस्ट डिविडेंड एंड रिजल्ट अपडेट्स। बेल आइकन दबाना मत भूलना।
TCS के इन्वेस्टर्स के लिए बड़ा अपडेट। क्या 120 का बम्पर डिविडेंड फिर से आ रहा है? 10 जुलाई को बोर्ड मीटिंग में हो सकता है पैसा बरसे और Q1 के रिजल्ट्स भी होंगे रिकॉर्ड ब्रेकिंग। क्या आप शेयर होल्डर हैं? क्या आपके अकाउंट में पैसा आने वाला है? वीडियो में पूरी ब्रेकिंग डिटेल मिलने वाली है। ब्रेकिंग न्यूज समरी ऑफिशियल अपडेट। टीसीएस ने सेबी को इन्फॉर्म किया है कि 10 जुलाई 2025 को उनकी बोर्ड मीटिंग होने वाली है। इस मीटिंग में 3 बिग डिसीजंस लिए जाएंगे। Q1 FY26 के स्टैंड अलोन रिजल्ट्स अप्रूव होंगे। कंसोलिडेटेड रिजल्ट्स भी बोर्ड के सामने रखे जाएंगे। इंटरिम डिविडेंड का डिसीजन भी लिया जाएगा। Why this is big for investors?
Hello friends, welcome to my channel Finance Eco India. HCL just dropped its Q1 financial year 26 results. Revenue beat expectations, but profit fell almost 10%, and the stock barely budget. Wonder why? We break it down with deal insights, margin trends, and what it means for you. Smash subscribe if you want live market breakdowns. Now let's check if HCL result beat the estimate or not. HCL Tech posted 30,349 crore in Q1 financial year 26 revenue, up 8% year on year, just edging past the 30,292 crore consensus estimate. Net profit came in at 3,843 crore, down approximately 10% year on year, missing the rupees 4,224 crore estimates, reflecting margin pressures. Interim dividend of rupees 12 per share was declared, reinforcing HCL's shareholder-friendly approach. So what does this mean? A revenue beat, but profit miss signals pressure from investment and softer utilizations. The dividend demonstrates management confidence despite earning dip. So HCL Tech's Q1 revenue jumped 8.16% year on year to rupees 30,349 crore, slightly surpassing the consensus. This growth was led by strong performance in Europe and rest of the world markets, highlighting recovery in these geographies. However, the growth wasn't across the board. 4 of its 7 industry segments actually saw decline, including manufacturing, life science, healthcare, and public services. In essence, global diversification helped the top line beat expectations, but core segments were under pressure, signaling that growth remains uneven and demand recovery is still patchy. So talking about the HCL's net profit, its net profit fell nearly by 10% from the previous year. Why it dropped? There are many reasons. One is the seasonal softness and utilization dip. The June quarter typically brings lower utilization level reducing efficiency. Higher investment. So HCL increases spending on Gen AI and go-to-market initiative, impacting margins. So these are the new technologies. So there are initial investment which HCL has to do, which led to the margin pressure. Pricing pressure and FX headwinds. Currency volatility and competitive pricing further skews margin. So management narrowed financial year 26 constant currency revenue growth to 3 to 5% from 2 to 5% and set EBITDA margin guidance at 17 to 80%, down from the previous year 18 to 90% range. While revenue showed resilience, profit construction reflect a strategic choice. Investing in future growth during a seasonally weak quarter, margin stability and execution will be the key catalyst to watch moving forward. Now let's talk about the HCL deal wins. So HCL Tech secured around $1.81 billion in new deal wins during Q1 financial year 26, down from the $3 billion in Q4, but still solid in a typical weak quarter. What behind the slowdown? It reflects the extended decision cycle across silent client sectors, especially amid macro uncertainty and tariff concerns, pushing some large deals out to later quarters. Looking ahead, analysts forecast another $2.5 to $3 billion in booking this quarter. Similarly, concern on cost optimization contract and hesitant discretionary spends. While HCL Q1 booking dipped sequentially, the pipeline remained healthy. The focus now shifts to how quickly new deals convert and whether the demand environment starts to stabilize after this seasonal dip. Geographically, HCL Tech reported a mixed performance in Q1 financial year 26. Europe and rest of the world showed strong growth momentum, benefiting from diversified demand and stability outside the US. The US market remains soft under pressure from tariff uncertainty and cautious corporate IT budgets. Asia continued to show weakness with slow deal wins and delayed client decisions. By vertical performance varied sharply. Leading sectors, BFSI and high-tech delivered solid results due to sustained digital transformation and cloud projects, but manufacturing and retail lagged, reflecting slower client capex and reduced discretionary IT spends. Strategically, HCL is doubling down on Gen AI, digital engineering, and ENRD services, aiming to pivot client toward high-growth, value-added offerings. This shift reflects a clear intent to offset volatility in trading sector and align with future tech trends. Now let's talk about what analysts are saying. Guidance is narrowed to 3 to 5% growth, margin to 17 to 18%. Stock closed flat, margin digests the rebound in revenue, but cautious on margins. Here's the big picture. HCL Tech reported a revenue beat but tempered investor expectations by narrowing financial year 26 growth guidance to 3 to 5%, with projected margin of 17 to 18%, down from earlier levels. The stock reaction was muted, closing flat, reflecting market cautious. Investors are still weighing the positive in revenue against the conservative margin outlook. So solid top-line execution is now balanced by prudent guidance. Analysts expect steady deal flow and Gen AI-driven services, but margins will be the key to watch. Now let's talk about the risks and the headwinds. So tariff turmoil in the US is delaying client IT projects as companies push back discretionary spend until trade clarity returns. This slowdown is particularly pronounced in H2CY analysis of global supply chain. At the same time, key industry verticals like manufacturing and healthcare have reported soft revenue growth, reflecting cautious corporate budget and subdued demand. And it's not just the top line. Margin pressure are persisting, triggered by typical seasonal utilization dip in Q1. Increased investment in GenAI and currency headwinds from the depreciating rupee and contracting US dollar. In summary, HCL Tech's Q1 performance show external macro factors, tariff, disrupting deemed timelines, weak industrial spending, dragging growth and margin pressure from strategic investment, and underutilization. The key question now, will Q2 show a rebound as these headwinds ease? So let's discuss now what are the good signs which HCL is showing. So there are also some good factors. So HCL Tech's Q1 setup is showing some clear upside potential. Strong GenAI acceleration. HCL is working on 200 plus GenAI POCs with many already scaling to production, signaling climb to AI-driven digital transformation projects. Budget recovery in BFSI and high-tech. This core vertical led the charge with recovery momentum and renewed discretionary spend, fueling growth in the quarter. Stabilizing margins. While Q1 saw typical softness, management expects margin to firm up in H2, especially as seasonal pressure fades and GenAI investments start yielding returns. So the bottom line is that HCL pivot to high-value GenAI and steady recovery in key sector provides a strong counterbalance to summer quarter drag, setting the stage for a stronger H2. Now friends, let's discuss about what should be our strategy, investment strategy. For long-term investor, with current 3 to 5% guidance and continued digital push, the next 12 months could offer steady returns, especially if margin holds above 17%. For short-term investor, post-earning volatility offers entry around 1600 to 1620 with upside to 1700 if guidance is reaffirmed. To wrap up, HCL Tech beats revenue, but margin squeezes and cautious guidance limit the upside. Watch for Q2 commentary on GenAI and deal flow. This could be a turning point. Are you bullish, neutral, or waiting on the sidelines? Please drop your comment below. And if this helped, please subscribe for my channel and for more videos like this. Thank you. Jai Hind. Hello friends, welcome to my channel Finance Eco India. Big news from ICICI Prudential Life. Q1 profit jumped a staggering 34%. Premium rose, cost fell, but ULIPs lagged. Stay tuned for a full breakdown, stock reaction, management insight, and what investors should consider. But before that, please subscribe to my channel Finance Eco India. So friends, let's start with the numbers. PAT surged to rupees 302 crore, up 34% year on year, a clear beat. Net premium income climbed 8% to rupees 8,503 crore, driven by a 20% jump in one-time single premiums. Annual premium equivalent slipped 5% to rupees 1,864 crore, reflecting slower sales in saving-linked products. Value of new business declined slightly to rupees 457 crore, but the VNB margin improved to 24.5%. AMU grew by around 5% to rupees 3.24 lakh crores, while operating cost fell, pushing the cost to premium ratio down to 21.2% from 24%. So let's discuss what management is saying. MD and CEO Anup Bagchi said our Q1 financial year 26 performance demonstrates the strength and resilience of our business model. Retail protection APE grew 24.1% year on year, and saving business saw cost ratios improve by 270 basis points. Image protection grew over 36% year on year in total new business sum assured, showcasing depth of retail customer engagement. So let's discuss the stock reaction and technical setup. The stock responded positively, rising around 1% intraday, backed by SEBI registered analyst, noting a bullish breakout on technical charts. Analyst Rajnish Sharma highlighted support between Rs 674 Rs 680 and resistance around Rs 720 to 725. A sustained breakout could drive the stock to Rs 760 to 800. So friends, now let's discuss what brokerages are saying. Brokerages pointed out that profit growth was led by improved investment income and cost discipline, despite a drop in APE. ULIP sell fell due to market volatility from US policy uncertainty. However, ICICI Prudential smartly shifted focus to higher margin protection products. Retail protection APE rose 24.1% year on year, while overall protection APE increased 15.2%, signaling a stronger traction in this segment. With an improved cost premium ratio and a solvency ratio of around 212%, the company continued to demonstrate balance sheet strength. So friends, let's discuss now what investors should do. For long-term investor, strong profit growth, rising AUM and protection focus makes this a solid buy or hold. Accumulate near support around Rs 670 to 680 for potential upside to Rs 760 to 800. For short-term traders, look for buy signal above Rs 720 with stop loss near Rs 680. Target are in the range of 760 to 800 June if momentum continues. So what all risk we need to look for? Weakness in saving linked AEP and any reversal in VNP margin, market volatility affecting ULIP premiums, micro headwinds like global market, uncertainty or interest rate shocks. So friends, to wrap it up, ICICI Prudential gave investor reason to cheer with strong earnings, improved margins and healthy protection growth. The stock's technical poised for a breakout, but watch the Rs 680 support carefully. If this analysis helped you, please like, subscribe and hit that bell for more earning reviews and market insight. And for now, what's your move? Buy, hold or wait? Let us know in the comment. So please do subscribe my channel Finance Eco India. Thank you and Jai Hind. Hello friends, welcome back to my channel Finance Eco India. Today ITC Hotels just declared Q1 financial year 26 results. Profit up by 54% and revenue up by 16%. But did these numbers beat analyst expectations? Stay tuned as we break down the key figures, stock reactions, management commentary and what it means for your investment. But before that, please subscribe to my channel Finance Eco India. So Q1 revenue came in at Rs 815 crore, beating the expectation of 800 crore by about 2%. EBITDA rose by 19% year on year to Rs 246 crore with a strong margin of 29.9%. Profit after tax soared to Rs 133 crore, well ahead of the anticipated Rs 125 crore, another solid beat. So friends, ITC Hotels fantastic result is also reflected in today's share price. It jumped 7% intraday to an all-time high of Rs 244.4 after the results. In July alone, it surged over 12% and nearly 35% since listing. Technically, it's maintaining a bullish trend, consistently holding its 15 days DEMA. So friends, let's discuss what management is saying. Though official earning call insights are pending, high-level commentary points to resilient demand across segments, with Q1 performance reflecting strong leisure and business travel recovery. Board approved for Rs 328 crore capex in Visakhapatnam, underscore strategic expansion. As India's third largest hotel chain, operating over 140 properties under Marriott Luxury Collections, Welcome Fortune, another ITC hotel, is tracking sector-wide recovery post-COVID. With a strong international and domestic travel resumption, it's outperforming broader FT hotel trends. Analysts project 20% annual earning growth and 12% revenue growth over the next 3 years. So let's discuss what investors should do. For long-term investors, results highlight a recovery phase and a strong demand trend. If you are bullish on hospitality, a buy on dip strategy around rupees 230 to 235 makes sense. Look for upside to rupees 260 to 275 in the medium term. For short-term traders, monitor support at rupees 235 to 240. A break below may open a slide toward rupees 225. A break above rupees 245 could trigger a fresh rally to rupees 260. So let's discuss some of the risks also associated with this. A Q2 sequential dip is possible due to seasonality. Economic slowdown or travel restriction could squeeze occupancy and profitability. Rising capex may impact near-term margins. To sum up, ITC Hotels delivered a strong Q1 financial year 26 beat. With robust year-on-year growth, margin resilience, and bullish price action. For investors bullish on India's travel and lodging sector, now may be a good time to accumulate with an eye on rupees 260 to 275. Traders watch those support and resistance level closely. Found this helpful? Please like, subscribe and hit the bell, and subscribe my channel Finance Chico India. Share your thoughts. Are you buying the dip or holding until more clarity? Drop a comment below. Thank you. Jai Hind. Hello friends, welcome to my channel Finance Chico India. Today Tata Technologies just declared its Q1 financial year 26 numbers, and they have shocked the market. Revenue plunged versus expectations, while profit still held its ground. Stay tuned, we break down the why and what it means for investors. Make sure you subscribe for live result reactions. Before Q1, analysts were moderately optimistic. They predicted revenue of around 1,208 crore rupees, net profit at rupees 157 crore, EBITDA near rupees 171 crore, and operating margin of approximately 14.15%. However, the market sentiment was cautious. The stock was trading near rupees 700, already down 50% from its peak of 1400 post IPO, reflecting investors' concern over growth momentum. In short, analysts expected flat to modest performance, but the stock was already priced for trouble. Investors were bracing for a rough quarter. In a shocking miss, Tata Technologies reported Q1 revenue of rupees 740.8 crore, a drop from rupees 761.8 crore in Q4, and a glaring shortfall against the rupees 1,208 crore analyst has projected. That's a massive rupees 467 crore miss, over 40% below expectation. Why the drop? The decline stems from delayed deal ramp-up and macroeconomic headwinds, especially in automotive and aerospace engineering, their core verticals. If you compare it with Tier 1 tech peers like TCS or Tata Elxsi, they saw only marginal dips this quarter, not a plunge of this magnitude. Technically, the stock has been considering consolidating in the rupees 695 to 720 range. A drop below rupees 695 could trigger a slide toward rupees 650, while a breakout above rupees 735 might indicate a rebound. This quarter was a tough one. Major revenue underperformance, signaling deeper demand issues. Stay tuned for a management commentary that will determine if Q2 shows a rebound or a deeper slowdown. Friends, now let's talk about the profits. Tata Technologies delivered a strong Q1 performance. PAT rose 5.1% year-on-year to Rs 170 crore, up from Rs 162 crore last year, showing soft sequential profit decline from Rs 189 crore in Q4 financial year 25. Operating EBITDA margin remained steady at 16.1% and PAT margin stood at 13.7%, both demonstrating robust profitability despite weaker top line. Why this resilience? Tight cost controls and disciplined working capital management sustained margin. Higher other income bolstered the bottom line, cushioning revenue softness. Looking ahead, management expects sequential recovery in Q2, driven by a stronger deal pipeline, improving client confidence. Tata Tech Q1 showed that even with slight revenue pressure, disciplined operation and financial resilience delivered profit growth, a promising base for future recovery. Tata Technologies reported a sharp revenue decline in Q1, driven by a demand slump in automotive and aerospace engineering, its core business area. A combination of slowing global EV spending and rising US tariffs weighted heavily on its results. In Q4, the company showed strength through new generation design wins, but this quarter told a different story. Instead of growth momentum, we saw broader cyclic pressure, auto major pulling back, delayed project start, and cautious client investment. Global macro dynamics like slowing EV adoption and geopolitical trade hurdles are clearly impacting engineering spend. Investors were expecting Tata Tech to ride through slower quarter more smoothly, but Q1 is a clear indication that recovery may take longer. To recap, Q1 revenue weakness reflects structural headwinds, not seasonal noise. The key watcher now includes management's commentary on deal pipeline ramp up and whether micro wars ease in H2. So let's discuss now what analysts are saying. Analysts entered Q1 with bearish technical, primarily watching the Rs 695 to 720 trading range. A break below 695 could trigger a drop to Rs 650, whereas a strong market reaction optimism guidance could push the stock above Rs 375. However, the revenue miss was so significant that it's forcing analysts to rethink their outlook. Despite a profit beat, the sharp top line raised fresh concerns. Bottom line, be cautious. The technical picture was already weak and the earning miss may delay any strong rebound unless management provides a clear roadmap. Let's now discuss about the risks and the red flags for this stock. Tata Technologies. Tata Technologies faces prolonged weakness in its core verticals, automotive and aerospace engineering, which disappointed investors expecting a smoother quarter. This isn't just seasonal, it's a structural slowdown. Several announced deal pipeline have been pushed back, signaling slower revenue realization and raising concern about deal velocity and client confidence. On the charts, the stock is approaching a critical zone between Rs 650 to Rs 620, where analysts believe that the market may increasingly price in going headwinds if no good news comes soon. In summary, the combination of core segment softness, deferred deals, and market sentiments pointing toward Rs 650 to 620 suggests the stock could enter a downside bias unless positive catalysts emerge. But it's not all bleak. Profit held strong. Tata Technologies posted a 5% year-on-year PAT increase to Rs 170 crore despite flat revenue, showcasing tight cost discipline and smart expense management. Deal momentum remains. They secured 6 strategic deals, including wins with Volvo Car and a European luxury OEM, indicating that the firm is successfully navigating the downturn and laying the groundwork for recovery. All eyes on Q2. If the macro environment improves and pipeline convert, the stock has room to bounce back. This quarter sets the stage. Watch for upcoming signals. Pipeline update, macro recovery and client confidence in Q2 will determine whether this resilience turn into a full-fledged rebound. So friends, now let's discuss about the upcoming triggers to watch. Q2 guidance and pipeline commentary. Management has already expressed optimism for a Q2 sequential recovery driven by strong deal wins and execution. Deal announcements. Keep an eye on update from major deals with companies like Volvo Car and European luxury OEMs. Sectoral recovery. A rebound in EV spending and aerospace capex would significantly support growth. So now let's discuss about the strategy for the long-term investors. If Tata Tech sustain margins and volume bonds, consider accumulating between rupees 650 to 700 as it could offer strong upside potentials. And for traders, watch critical level. A break below rupees 695 to 700 may trigger a slide toward rupees 650 to 620. Conversely, a breakthrough above rupees 75 could signal a strong technical rally. So the bottom line is that evaluate Q2 commentary and pipeline momentum first. If possibly returns, the rupees 650 to 700 band should be an attractive entry. Should play breakout more carefully. So Q1 is a tale of big revenue weakness but resilient profit, not a buy outright, but potentially a watch and wait zone around rupees 650 to 700. What are your bets? Dip buy, hold or skip this quarter? Let me know in the comments, and don't forget to like, subscribe and hit the bell icon for more detailed analysis of the company's quarterly results. Thank you for watching. Jai Hind. Hello friends, welcome back to my channel Finance Eco India. Today we explore Tata Elxsi's Q1 Financial Year 26 results. Revenue at 892.1 crore, EBITDA at margin at 20.9%, PBT margin 21.1% and PAT at 144.4 crore. But did Tata Elxsi meet expectations? Stay tuned for in-depth analysis, comparison and what it means for investors. Disclaimer: the information provided in this video is for educational and information purpose only and does not constitute financial investment or trading advice. So friend, let's get started. Tata Elxsi reported operating revenue of 892.1 crore for Q1 Financial Year 26, a decline from approx 926.5 crore in Q1 Financial 25 and also below expectations. So it missed top line expectations. EBITDA came in at 186.7 crore or 20.9% margin. PBT at 196.3 crore, it is 21.1%, and PAT at 144.4 crore, 15.5%, aligning with internal guidance. Below consensus revenue indicate near-term softness, but margin held strong. So coming to the guidance, CEO Manoj Raghavan emphasized macro challenges and subdued R&D spend, yet highlighted resilience, a 3.7% Q-on-Q recovery in transportation, backed by large SDV deals with Mercedes-Benz and Suzuki. He flagged softness in media, a decline of 5.5% Q-on-Q CC, and healthcare declined by 6.7%, but emphasized strategic win in AI design, digital and global pharma contracts. So now friends, let's deep dive into the sectors from which Tata Elxsi earns. So in transportation sector make up over 50% of revenue. It grew 3.7% Q-on-Q in actual flat CC. A solid recovery driven by new SDV deal wins. CEO expects continued momentum due to a healthy deal pipeline and new customer engagement. So other vertical is media and communication, which declined 5.5% Q-on-Q in constant currency term, hurt by transitional costs tied to large deals. However, Tata Elxsi expects a rebound in Q2, especially with a new multi-million-dollar design project for a US tech leader in AI. So the third vertical in which Tata Elxsi works is healthcare and life science, which dipped by 6.7% Q-on-Q in constant currency terms due to tariff impacting US medical device engineering spend. But two strategic wins, Global Pharma Europe and MedTech Japan, promise a recovery in H2 financial year 26. So due to Trump tariffs, this company is also too much impacted. Tata Elxsi design team delivered the Bharat Pavilion at Osaka World Expo 2025, ranked among the top 5 globally. Their new AI-first website also underscore their agility and human-centric innovation. So Tata Elxsi's EBITDA margin of 20.9%, PBT at 21.1%, and PAT margin at 15.5% demonstrate sustained cost discipline despite revenue pressure. Margin resilience is a strong positive in the cycle headwinds. So friends, let's talk about what analysts are saying about the Tata Elxsi. Analysts from HDFC, Kotak and Bloomberg expect Q&Q CC revenue decline of 2 to 3% and margin compressions. Tata Elxsi actual revenue and margin patterns align with that cautious view. Stock sentiments remain neutral, with investors watching for Q2 recovery signals. So let's discuss about the risk associated with Tata Elxsi. There's ongoing weakness in the transportation and media communication vertical, driven by macro uncertainty and a global slowdown in R&D spending. These headwinds could pressure short-term revenue growth. But there's the upside. Tata Elxsi is actively ramping up software-defined vehicles, SDV deals, with marquee names like Mercedes-Benz and winning new AI and digital design projects. Strategic wins in healthcare and global showcase like the Bharat Pavilion at World Expo add credibility. So while near-term challenges persist, strong deal momentum across future-facing tech gives long-term growth visibility, a balanced risk opportunity picture. Let's wrap up now. Tata Elxsi posted 892.1 crore revenue with a stable margin and strategic wins, but revenue missed expectation. The quarter shows operational resilience and preparedness for a Q2 turnaround. If you are confident in cyclic recovery and deal execution, this could be an opportunity to accumulate quality design tech exposure. Drop your thoughts below. Will you buy on weakness or sit tight? And don't forget to like, subscribe and hit the bell icon for more in-depth analysis. To subscribe my channel Finance Eco India. Thank you. Bye bye for now. Hello friends. Today we are diving deep into TCS Q1 results. Revenue of 63,437 crore, 12,760 crore PAT, an extended interim dividend of 11 rupees per share. Did TCS beat or miss expectations? Let's unpack it. But before that, please subscribe my channel. Disclaimer: the information provided in this video is for educational and information purpose only. It does not constitute financial advice, investment advice, or a recommendation. TCS reported revenue of 63,437 crore for Q1 financial year 26, missing estimates of 64,636 crore by about 2%. Despite a 1.3% year-on-year rise, this shortfall signals weak underlying demand, as revenue actually fell 3.1% in constant currency and declined 1.6% sequentially. On the profit side, PAT came in at 12,760 crore, beating consensus by around 5%. A Q1Q rise of 4% highlights profit resilience amid headwinds. Margin drove the surprise. Operating margin improved to 24.5%, up 30 bps from Q4, while net margin rose to 20.1%. This margin expansion reflects disciplined cost control and pricing power despite softened revenue. Another positive step, TCS declared an 11 rupees per share interim dividend with July 16 record date and August 4 payout, reinforcing its commitment to each return. So here's the verdict. TCS underperformed on revenue but outperformed on profit, thanks to margin expansion. The dividend adds further confidence. It's a tale of operational efficiency, rescuing headline softness, signaling disciplined execution even in a muted growth environment. TCS recorded 1.3% year-on-year revenue growth, but the story beneath the headline tells a different tale. On a constant currency basis, revenue actually shrunk 3.1%, reflecting a sharp decline once forex gains are removed. Sequentially, revenue declined about 1.6% Q-on-Q, yet analysts were bracing for a near-flat result in CC terms. So TCS underperformed even modest street expectations. The BSNL project ramped down significantly reduced revenue, cutting growth by around 75 basis points. According to broker projections, macro-related caution in client spending, especially amid global and US tariff jitters, hit discrepancy IT budgets. Put simply, the reported 1.3% growth was driven entirely by currency tailwinds. The actual business volume weakened, with BSNL winding down and enterprise caution persisting. The underlying picture is subdued. This indicates TCS is riding on forex strength, not organic demand, underscoring the need to watch Q2 performance closely. TCS reported a 24.5% operating margin, up a solid 30 basis points sequentially, with net margin climbed to 20.1%, a year-on-year gain of 90 bps, indicative of robust cost control and pricing power. Why margin expanded? Cost saving from the winding down of BSNL ramp-up and delayed wage hikes, high margin contracts in AI-led digital cybersecurity and cloud, pricing discipline, maintaining premium service despite weak demand. What it means? Margin expansion amid soft revenue growth shows TCS is lean and agile, prioritizing efficiency. This is not a flash gain, it stems from deliberate execution on cost rationalization and strategic deal wins. TCS reported a total contract value of $9.4 billion in Q1 FY26, a solid performance, though down from $12.2 billion in the previous quarter, making a 23% sequential decline. Despite the drop, TCS exceeded street estimate, which predicted TVC to have hovered around $8 to $9 billion. This shows that deal pipeline remained resilient in a challenging macro environment. Focus sectors include AI, cloud, cybersecurity, quantum computing, and SAP modernization. Core highlight margin service that signal the company is aligning with future enterprise priorities. Even as overall contract value dipped, the mix is increasingly skewing toward next-gen, future-ready technologies. TCS's strength in AI-led transformation projects remain a key growth pivot, ensuring the company is well positioned for long-term value creation. TCS delivered net cash from operation of 12,804 crore, which equates to 100.3% of its net profit, strong indicator of cash flow quality and earning sustainability. On the talent front, the company added 6,071 employees sequentially, taking its total headcount to 6,13,069 as of June 30, 2025. However, the attrition rate has risen modestly to 13.8%, nearing a 2-year high. Strong cash conversion, 100% of net profit, is a hallmark of disciplined operational and healthy working capital. The ongoing hiring spree, even amid higher attrition, shows that while TCS is expanding its talent base, it's also facing retention challenges. This suggests a more cautious, efficiency-driven talent strategy in a complex demand environment. Here's how TCS performed across verticals, CC terms year on year. BFSI growth was 1%, while energy, resource and utilization climbed 2.8%. In contrast, sectors like manufacturing fell 4% and both life science and healthcare and media and communication plunged 9.6% each. Geographically, North America dropped 2.7%, Continental Europe 3.1%, and India suffered a steep 21.7% decline, reflecting softness in the BSNL contract. Meanwhile, Asia Pacific grew 3.7%, Latin America 3.5%, and MEA led with 9.4% growth. Broad-based weakness prematured key verticals and core markets, signaling subdued demand across TCS major business areas. Only MEA and APEC shows pockets of resilience. This uneven performance highlights the urgent need for TCS to pivot into stable, high-growth markets and industries as global pressure persists. TCS Q1 Financial Year 26 results were weighted down by several external challenges, a sharp decline in BSNL-related revenue as the large telecom project winds down. US macroeconomic tariffs and geopolitical tensions have dampened client confidence in discretionary IT spendings. Client investment are being deferred. The result, enterprise capital expenditure is being postponed, further impacting demand from large corporate clients. The continued global macroeconomic and geopolitical uncertainties caused a demand contraction. These aren't isolated issues. They are structural headwinds with BSNL ramp down, US policy risk, and cautious corporate budget. TCS is navigating a challenging revenue environment. Investors should watch for recovery signals in enterprise spend and tariff stability. Following the Q1 results, TCS share edged up 0.3 to 0.4%, reflecting a neutral to slightly positive investor response to the profit beat despite the revenue miss. Analyst sentiment skewed toward cautious optimism. Brokers such as Kotak, Incred, Nomura, and others projected flat to slightly lower margins, anticipating a modest Q-on-Q dip in revenue of 0.5 to 1% in CC terms, primarily due to BSNL ramp down. While some analysts maintain a hold stance, a few viewed TCS as a buy, citing resilient margins and strong cash flow as key supportive factors. Overall, the market largely shrugged off the revenue shortfall, recognizing the earnings strength and margin resilience. Analysts are now looking ahead to Q2, expecting clear signal on enterprise spending and macro trends. Would you like this crafted? So now let's talk about the risk associated with this. Constant currency revenue weakness across multiple vertical and geographies, highlighting notable demand softness. Ongoing business taper continue to drain top-line growth, especially in India. Macroeconomic volatility, including US policy uncertainty and global enterprise capex delay impacting discretionary IT spends. Opportunities: margin resilience. While operating at 24.5% and net margin at 20.1% demonstrate strong cost management. A strong TVC of $9.4 billion and continued momentum in AI-led transformational services ensure future growth potential. Robust cash flow, rupees 12,804 crore is greater than 100% of net profit, provide flexibility for reinvestment and shareholder returns. TCS faces pressure from structural demand issue and macroeconomic headwinds, yet the company counters these with operational efficiencies, strong contract wins, and rock-solid cash flows, offering both defense and amenities for growth. Investors should track how effectively TCS converts its strong TVC and resilient margin into sustained revenue once macro condition improves. So TCS delivered a profit beat and margin expansion, reflecting strong execution even as revenue softened. This underscores operational discipline and resilience. Caution on revenue. However, revenue underperformance, particularly in constant currency, signal weakness in volume and underlying demand, highlighted by the impact of BSNL's taper and macro pressure. In Q2, what to watch? Keep an eye on whether the BSNL RAM resumes, if enterprise capex normalize, and whether macroeconomic clarity, especially around US tariff, emerges. So for long-term investor, consider accumulating on dips as the business fundamentals are solid and cash flow remains strong. For short-term traders, focus on clarity in revenue recovery and micro trends before taking new position. So you will buy on weakness, hold tight, and wait for more data. Please hit like, share and subscribe this channel. If you like this content, please bell for future earning insights and do follow my channel for more such videos. Thank you. Hello friends, welcome back to my channel Finance Eco India. Today we are diving deep into the Polycab India's Q1 financial year 26 results. We will check if it missed or beat the street estimates, financials, management commentary, and what investors should do. Before that, please subscribe my channel Finance Eco India. So good news for the Polycab investors. Polycab India delivered an exceptionally strong performance in Q1 financial year 26, showcasing significant growth across its core business. The company reported a stellar 50% year-on-year increase in net profit, reaching Rs 592 crore in Q1 financial year 26, up from Rs 396 crore in same quarter last year. Revenue from operation also saw a robust rise of 26% to Rs 5,986 crore from Rs 4,756 crore. Earning before interest, tax, depreciation and amortization surged 46% annually to Rs 938 crore, leading to a notable improvement in the EBITDA margin by 220 basis points from 13.49 to 15.66. So let's discuss what analyst has to say. While specific Q1 financial year 26 analyst estimates were not explicitly available, analyst has recently increased EPS estimate for future period by 12% and forecasted annual earning revenue growth of around 14.5 to 14.6%. Polycab reported 50% PAT growth and 26% revenue growth, significantly exceed this general analyst growth forecast, indicating a very strong performance and a notable beat. Inder T. Jayashangrani, Chairman and MD of Polycab India, stated that the company commenced financial year 26 on a strong footing, delivering our highest ever first quarter revenue and profitability. He expressed confidence in the company's ability to capitalize on future opportunities, citing continued momentum in government spending and improving project execution on the ground. Now let's discuss about the company's outlook and business growth. The strong performance was driven by the wire and cable segment, which achieved 31% year-on-year growth. This was fueled by sustained domestic demand, higher government expenditure, and improved project execution. The domestic wire and cable business grew 32% year-on-year, with cables outperforming wires, and both channel and institutional sales showing healthy traction. The fast-moving electrical goods segment also continued its healthy growth trajectory with an 18% year-on-year increase, making it second consecutive profitable quarter. With FMEG solar products saw exceptional growth, more than doubling year-on-year became the largest category. Polycab's strategic program underpinned this robust performance. Project Leap, a multi-year transformation journey successfully concluded, achieving its $200 billion revenue goal a full year ahead of the financial year 26 target. Building on this success, the company launched Project Spring, a new multi-year strategic program for the next 5 years. Project Spring aims to grow the wire and cable business at 1.5 times the industry growth rate, targeting market share gain and achieving a long-term EBITDA margin of 11 to 13%. It has sought to increase international business contribution to over 10% of the top line and grow FMEG revenue at 1.5 to 2 times industry growth, targeting an EBITDA margin of 8 to 10%. To support these goals, Polycab planned to invest 60 to 80 billion in capital expenditure over the next 5 years for capacity expansion, backward integration including an EHV cable production facility in Halol by financial year 26, digitalization and ESG initiative. These investments are planned to be funded through internal accruals with a commitment to increasing dividend payout to 30% or higher. So Polycab's Q1 financial year 26 result demonstrate effective execution across its core segments, with the wire and cable business directly benefiting from favorable macroeconomic tailwind such as government capital expenditure and robust real estate demand. The sustained profitability of the FMEG segment is particularly noteworthy, indicating a successful strategic alignment and product premiumization initiative. This turnaround in FMEG is crucial as it diversified revenue streams and enhanced overall profitability, reducing sole reliance on the wire and cable segment. The company's sustained capital expenditure plan and its commitment to funding this through internal accrual underscore strong cash flow generation and a confident outlook on future demand. This strategic position is expected to drive continued market share gain in both the organized wire and cable and expanding FMEG market. Now let's talk about what investors should do. For investors, Polycab share ended 1% lower than the earning announcement, possibly due to profit taking following recent gains, 10.44% in the last month. However, analysts largely maintain buy ratings with target price indicating significant upside of rupees 8,300 to 8,741. Despite short-term stock fluctuations, the strong fundamental, clear strategic direction and positive long-term outlook from analysts make Polycab an attractive position for those seeking exposure to India's infrastructure and consumption growth story. While risks include fluctuating raw material prices and increasing competition, the company's market leadership and strategic initiatives are positioned to mitigate these challenges. If you like the analysis, please hit the subscribe button and press the bell icon, and do subscribe to my channel. Thank you and Jai Hind. Welcome investors to our rapid fire Q1 financial year 26 earning review. India's corporate giant have just unveiled their latest financial performance, and we are here to break down the key takeaways. We will cover whether they beat or missed analyst expectation, what management is saying, and what it all means for your investment strategy. Before that, please subscribe my channel Finance Eco India. So firstly, let's talk about Jio Financial Service JFSL. This quarter JFSL showed a mixed bag. While net profit saw a modest 3.8% year-on-year increase to rupees 325 crore. Revenue from operations surged a massive 47% to rupees 612 crore. This revenue jump actually beat analyst expectation for moderate growth. The significant increase in expense, up to 28%, signal aggressive investment in scaling up. CEO Hitesh Sethia emphasized that the company is leveraging its demergent capital to support early stage business and deploy capital assertivity where unit economics are strong. Key initiatives include the successful Jio BlackRock Mutual Fund NFO, raising over 17,800 crore and expanding Jio payment back to over 50,000 touchpoints. For investors, while the stock ended marginally lower post results, analysts suggest a correction toward Rs 290 could be a long-term entry point as company prioritize market penetration ecosystem built out. So the next company is Indian Hotel Company, a Tata Group gem, delivered its 13 consecutive quarter of record performance. Net profit jumped 26% to rupees 329.32 crore, with total income rising 31.7% to rupees 2,102 crores. While specific Q1 analyst estimates weren't widely available, this strong growth likely beats general expectation. MD and CEO Puneet Chhatwal attributed this sustained success to their diversification strategy, with new ventures like Ginger, Cumin, and Amma Stays and Trails contributing significantly. Looking ahead, IHCL's Accelerate 2030 strategy aimed to double its portfolio to over 700 hotels and revenue to 15,000 crore, investing rupees 12 billion in financial year 26 alone. This strategic shift toward an asset-light model and diversified offering position IHCL to capitalize on India's booming tourism. Analysts remain bullish, citing robust demand and limited room supply. Moving to Axis Bank, reported a 4% year-on-year decline in net profit to Rs 5,806 crore. This missed most analyst expectation. However, the headline figure masks a strong operational performance. Operating profit rose 14% to Rs 11,515 crore, driven by a 25% jump in non-interest income. The profit dip was primarily due to a sharp rise in provisions, including Rs 821 crore from technical factors related to loan classification. CEO Amitav Chaudhary expressed optimism for financial year 26, stating that large, well-capitalized banks like Axis are best suited to seize opportunities, aiming to grow faster than the industry. The bank's digital strategy is robust, with 97% of individual financial transactions by digital channel and 15 million monthly active mobile users. For investors, it's crucial to look beyond the one-off provisions and focus on the underlying operational strength, digital adoption, and management confident outlook. Next, let's discuss Waaree Renewables, which showcased explosive growth in Q1 financial year 26. Net profit jumped an exceptional 207% year-on-year to Rs 86 crore, with revenue soaring 155% to Rs 603 crore. This was a significant beat against broader fiscal year forecasts. While profit dipped sequentially due to seasonality and one-time expense, the year-on-year performance was stellar. CFO Manmohan Sharma highlighted the robust growth from strong EPC execution and the strategic broadening into battery energy storage system solution. Waaree maintain a strong order book of 3.15 gigawatt power in solar EPC and 60 megawatt power in BESS EPC, with a substantial bidding pipeline. The company is well positioned to benefit from India's ambitious clean energy roadmap. For investors, while the stock saw some profit booking post-result, a strong order book and strategic diversification into new energy segments make it a compelling long-term play, though valuations are considered high. So finally, let's discuss HDFC Asset Management Company, delivering a strong Q1 financial year 26 results. Profit after tax increased by 24% year-on-year to rupees 748 crore, and revenue from operation rose 25 to rupees 967.8 crore. This performance significantly beat analyst forecast for profit and revenue growth. The company's quarterly average AMU grew 23% to rupees 829 lakh crore, with actively managed equity AUM up 22%. HDFC MC maintained a strong market share in individual investor AUM, leveraging its extensive distribution network of over 99,000 partners and 280 offices across India. Management attributed the strong result to disciplined asset management and consistent investor inflows, emphasizing ongoing digital transformation and financial education. With the Indian asset management industry projected for significant growth, HDFC AMC's strong market leadership and focus on individual investor position it well for continued success. The stock jumped to the 52-week high post-earning, reflecting strong market confidence. In summary, Q1 financial year 26 showcased a dynamic Indian corporate landscape. While some companies face temporary headwinds, the underlying theme is one of strategic investment, digital adaptation, and capitalizing on India's robust economic tailwinds. As always, through research and a long-term perspectives are key. Thank you for joining us. If you like the content, please subscribe to my channel Finance Eco India. Press the bell icon and comment which part you liked most. Thank you and Jai Hind. Hello friends, welcome back to my channel Finance Eco India. Tech Mahindra just reported its Q1 financial year 26 earnings, with net profit up by a hefty 34%, but revenue and profit slightly missed estimates. In this video, we will deep dive into the numbers, analyst expectations, stock reactions, management commentary, and what it means for your portfolio. Don't forget to hit subscribe and ring the notification bell so you never miss our IT sector coverage. So now let's begin by comparing actuals to what Wall Street and Indian brokerages expected. Based on LSEG and consensus forecast, Tech Mahindra profit rose sharply to 1,141 crore, a robust 34% increase, but fell about 6% short of the Rs 1,211 crore expected. Revenue to miss consensus at Rs 13,351 crore versus 13,383 crore. EBITDA and margin were steady at around 11.1%, expanding to 60 bps year-on-year. On the bright side, global deal wins reached $809 million, a strong signal for future growth. Now let's discuss revenue and geographical performance. While net profit bit happened on better margins, the revenue story was slightly softer, particularly in the Americas, which form nearly half of their top line, down 5.9% year-on-year. US tariff-related uncertainty is weighing on IT budgets, affecting discretionary tech spends. Constant currency revenue were flat or slightly down due to softness in high-tech and BPO segments. This mirrored analysis expectation of a sequential dip in CC terms. Margin continues to be the bright spot. Tech Mahindra delivered its 7th consecutive quarter of margin expansion thanks to project folios, efficiency initiatives, and rupee depreciation. EBITDA jumped 34% year-on-year to rupees 1,477 crore, up from rupees 1,378 crore last year. New contract win grew nearly 51% to $809 million, showing momentum from across verticals and geographies, a major confidence builder. So, despite missing revenue and profit estimates, Tech Mahindra's stock rose 1.8% intraday, indicating that market focused more on strong margins and deal pipeline. LSEG consensus and analyst commentary have highlighted that margin strength and ongoing deal momentum may offset macro headwinds. Kotak, Motilal Oswal, Navama all expected profit jump but flag revenue risk. Technical support near 1580 targets toward rupees 1650 plus if momentum holds. So let's discuss about management commentary and future strategy. CEO Mohit Joshi said, performance is steadily strengthening with disciplined execution. Deal wins have increased 44% on a trailing 12-month basis. CFO Rohit Anand highlighted the positive impact of Project Fortius and cost control, attributing margin gains to operational improvements. Tech Mahindra is pushing hard into high-margin verticals like BFSI, expanding its base from 16% to a goal of 25% of revenue by financial year 27, driven by generative AI initiative. Gen AI is seen as a crucial growth driver across services. Now let's discuss about the risk included in the Tech Mahindra's future. Continued weakness in Americas and tariff-related slowdown, project delays in high-tech BPO segments, currency volatility, but there are other opportunities also like margin expansion via Project Fortius, strong deal pipeline and TCV acceleration, strategic pivot to BFSI, banking and financial sector, and high-value digital services. Positive long-term macro outlook for AI-driven IT spend. Now let's discuss what investors should do. For long-term investor, Tech Mahindra remains a buy on dip near rupees 1550 to 1580, targeting upside to rupees 1700 to 1800, aligned with margin execution and BFSI ramp up. For short-term trader, watch near-term support of rupees 1580, breakout above rupees 1620, could spark a rally toward 1650 to 1700. Place protective stop loss 3 to 5% below entry. So what should we monitor? Q2 guidance on revenue growth and financial year 26 margin, traction in BFSI deal and Gen AI wins, US policy clarity affecting discretionary IT budgets. Let's sum up it. Tech Mahindra posted a strong profit beat, margin gain, and excellent deal wins, offset by minor revenue underperformance. With margin tailwinds and vertical repositioning, long-term investors have a solid case to hold or accumulate. Traders watch key technical zones carefully. Like this analysis? Hit like, subscribe and ring the bell for more Indian IT deep dives. What's your take? Buy, hold or wait? Drop a comment below and let's discuss. Thanks for being here. Do subscribe my channel and thank you and Jai Hind. Hello friends, welcome to my channel Finance Eco India. Today we will do comprehensive analysis of Reliance Industries Q1 Financial Year 26 results. In this video, we will explore the profit beat, segment-wise performance, analyst takeaways, what investors should do, management guidance, and the long-term play. But before that, please subscribe to my channel Finance Eco India. Now let's begin. So Reliance delivered a record-breaking quarter. PAT surged 78% to rupees 26,994 crore, exceeding street estimates by over rupees 4,900 crore. Revenue grew modestly, but EBITDA rallied strongly to rupees 58,024 crore, with margins expanding by 460 basis points, a stellar start to financial year 26. So earnings were boosted by three key drivers: a nearly 9,000 crore one-off gain from divesting Asian Paints stake, strong refining and petroleum margins in oil to chemical, and robust performance in retail and geo segment. Let's break down Reliance performance by segment. Oil to chemicals saw a healthy 10.8% year-on-year rise in EBITDA, fueled by strong refining margin and higher petrochemical demand. Geo led the charge with a 23.9% jump in digital EBITDA, supported by over 200 million 5G user and ARPU of Rs 208.8, with margin up about 210 basis points. Retail contributed strong momentum too. EBITDA rose 12.7% with revenue at Rs 84,171 crore and profit up 28% to Rs 3,271 crore. The oil and gas segment saw a modest dip, primarily due to natural depletion at the KG-D6 field. In summary, O2C grew 11%, Geo 24%, retail 13%, while oil and gas declined slightly. Reliance didn't just beat profit estimates, it surpassed consensus significantly. CLSA held this quarter as a pivotal moment, assigning a 14% upside given retail and telecom momentum. Meanwhile, JM Financial and Bonanza upgraded to buy, forecasting a strong 15 to 20% EPS compounded annual growth, citing sustained gain in geo and retail operation. So let's discuss the investors' action, what they should do. Strong buy. The conglomerate diversified triple engine model spanning oil to chemical, geo and retail generated robust earning across segments. Analysts view this mix of business and structural margin improvement as compelling for further upside. Monitor EBITDA substantially. While Q1 benefited from a one-time Rs 8,924 crore gain on the Asian Paints stake sale, core EBITDA excluding this still grew by approximately 15% year-on-year. Investors should watch if this strength holds without the non-recurring boost. So let's discuss the risk involved with this. Oil to chemical volatility and oil and gas pressure. Though OTC EBITDA is up 10.8% year-on-year, macro volatility like crude, margin swings or shutdowns could dampen results. Similarly, a natural decline in KG-D6 upstream production slightly dented the oil and gas segment this quarter. Overall reliance on core earnings and resilience in its key business lines underpin the strong buy call. But investors must keep an eye on margin stability and cyclical risks. So friends, now let's discuss the management commentary. Mukesh Ambani in Q1 Financial Year 26 performance said, Reliance has kicked off financial year 26 with a robust all-round operational and financial performance, even amid volatile global headwinds, remarked Chairman Mukesh Ambani after Q1 results were announced. Let's break it down. In the oil to chemical division, despite sharp fluctuation in crude prices, the business delivered strong growth. This was largely driven by sustained domestic demand and a strategic value-added solution through the Jio BP fuel network. The Jio digital segment continued its ascent, crossing 200 million 5G subscribers and over 20 million home broadband connection, while other becoming the world's largest fixed wireless access provider with 7.54 million users. On the retail front, Ambani highlighted resilience execution, noting a significant expansion in customer base, now 358 million, and a strong improvement in key operating metrics. The growth was backed by launching new store and launching in-house FMCG brands. So, Ambani message is clear. Despite global uncertainty, Reliance delivered performance across its energy, digital, and retail engine, reinforcing confidence in its multi-pronged growth strategy. So, the Q1 commentary highlights are O2C stood firm amid unstable energy market, while Jio scaled with 200 million plus 5G user and become largest FWA provider globally. So future growth will be driven by asset monetization, digital and retail scaling, and initial performance from the new energy vertical. Now let's discuss what investors should do. Here what to track after Reliance strong Q1 performance. Hold or buy. Momentum continues across Jio's digital service and retail, with both delivering solid double-digit EBITDA growth. This diversifies growth engine is driving confidence for sustained gain. Track margins excluding the rupees 8,924 crore one-off gain from the Asian Paint stake sale, core EBITDA still expanded meaningfully. Investors should watch if these core margins hold up in upcoming quarters. Monitor capex. Reliance is aggressively investing in its new energy vertical, tracking how much cash is being allocated to solar, batteries, and green hydrogen projects will be critical to understanding long-term growth potential. So micro things what we will watch: oil prices remain volatile and regulatory shift could affect refining margins. Given Ambani's comments on energy market uncertainty, this external factor must be monitored closely. So investors should stay on board. Jio and retail are firing on all cylinders, but keep a close eye on margin stability once one-off gain fades. Watch capex flow into new energy initiative to gauge long-term investment returns and stay alert to macro risks, especially oil price swing and policy change that could impact oil to chemical margins. So in summary, Reliance delivered strong results. Profit, margins, diversified segment strength. Analysts are positive. Investors should hold or build, tracking core EBITDA and strategic milestones. Thanks for watching. If you find this breakdown useful, please like, subscribe and share your thought. Is Reliance India's long-term play? See you in next video. Thank you and Jai Hind. Hello friends, welcome to my channel Finance Eco India. We will do rapid earnings review today. We are quickly breaking down the Q1 financial year 26 performance of two major IT service companies, Wipro and LTIMindtree. The quarter spanning April to June 2025 has been a telling period for the IT sector, revealing how companies are navigating global tech spending amidst ongoing macroeconomic uncertainties. Let's get straight to the numbers and what they mean for investors. Before that, please subscribe to my channel Finance Eco India. Let's first analyze Wipro, which announced its Q1 financial year 26 result on July 17. The story here is one of resilience in profitability despite muted revenue growth. Wipro reported consolidated revenue of round rupees 22,130 crore, a modest 0.8% year-on-year increase. In dollar terms, revenue was $2.58 billion, showing a slight sequential decline. However, the standout was their consolidated net profit, which jumped a robust 10.9% year-on-year to rupees 3,330 crore. This strong bottom line performance highlight effective cost management. Operating margin for their IT service segment also expanded to 17.3% and 80 basis points improvement from last year. Now, how did they compare to analyst expectation? Analysts have largely anticipated subdued revenue with forecasts ranging from flat to a modest 2% year-on-year growth. Wipro's actual revenue was largely in line with those expectations or slightly above the more pessimistic forecast. But on the profit front, Wipro clearly beat estimates with their rupees 3,330 crore net profit, landing at the higher end of analyst projections. A critical highlight for Wipro was the sharp increase in deal bookings. Total deal bookings soared to around $4.97 billion, a substantial 50.7% jump year on year. Large deal booking along surged by an impressive 131% to rupees $2.67 billion. Wipro's CEO Srini Pillai noted that clients are prioritizing efficiency and cost optimization to macro uncertainty, and Wipro's strategy led to these large deal closures. He also emphasized AI's central role in client strategies. For Q2 financial year 26, Wipro has provided conservative guidance, projecting IT service revenue to range from a 1% decline to a 1% growth in constant currency. However, management expects optimism for the second half of financial year 26, anticipating a stronger performance driven by his robust pipeline. For investors, Wipro current revenue is soft, partly due to weakness in Europe, but the massive deal win provides a strong foundation for future growth. The focus should be on how these deals convert into revenue in the coming quarter. So friends, now let's discuss LTIMindtree, which also reported its Q1 financial year 26 result on July 17th. LTIMindtree delivered a solid performance, showcasing consistent growth and a confident outlook. The company reported consolidated revenue of Rs 9,841 crore, marking a robust 8% year-on-year growth. In USD terms, revenue reached $1,153.3 million, up 5.2% year-on-year. Consolidated net profit saw an impressive 11% year-on-year rise to Rs 1,255 crore. EBITDA margin also improved sequentially to 14.3%. Comparing this to analyst expectations, LTIMindtree net profit of Rs 1,254 crore beat the consensus estimate of Rs 1,194 crore. While revenue was a marginal miss against estimate of 9,841 crore versus 9,855 crore. Their EBITDA and margin both exceed expectations. Operationally, LTIMindtree showed positive momentum. Client concentration risk decreased, with the top 5 clients now accounting for a smaller percentage of revenue, and the number of clients contributing over $20 million increased. They also achieved an improved utilization rate of 88.1%, reflecting efficiency. LTIMindtree CEO Venu Lambu described Q1 as a promising start, highlights broad-based growth and progress on strategic priorities. Management expressed confidence in achieving double-digit growth in Q1 26 and anticipates margin improvement from Q1 financial year 26 onward. The company is also actively leveraging AI, including in proprietary AI framework, Pilex AI, and filing patent in the AI domain. For investors, LTIMindtree shows strong immediate momentum and a confidently near-term outlook. Their focus on client diversification and strategic AI investment position them well for sustained growth. In summary, both Wipro and LTIMindtree are navigating a challenging IT landscape with distinct strategies. Wipro is building a strong future pipeline through large deal wins, while LTIMindtree demonstrates more immediate, broad-based growth and operational efficiency. The common thread is the persuasive emphasis on AI, which is becoming central to client strategy for both efficiency and innovation. For investors, a selective approach is key. Focus on companies that demonstrate strong execution, effective deal conversion, and strategic positioning in high-growth areas like AI. The long-term potential remains strong for IT firms that can adopt and innovate effectively. Please like, share, and subscribe to my channel Finance India. Thank you and Jai Hind.